Hello, everyone. It's David again, and I'm going to share with you week one of our project that we're getting started with. Okay, let's get into it. We're going to share the screen. This is our covered call strategy, and this is my first time doing this, so bear with me. And here we go. I think that's right. And we're going to start the slideshow. There's only three screens, four screens. And not sure how to, oh, we're going to share that. And we're going to start the slideshow. And here we go. So, what this has been all about is creating a retirement income. And the purpose of this really is to document it. And so this is week one documentation. We started with 30,000 Canadian because I'm Canadian, but we're going to share the numbers in USD. So we started with approximately $22,000. Okay, so the strategy. First of all, we're going to be doing a covered call option strategy. We're going to own those equities, and we're looking for high quality conservative equities. We're not going to go into great, I'm not going to go into great detail today. And certainly, if you have questions, we will, and we will go into detail as we go further along. But the bottom line is these are covered calls, and we're going to own those equities, and we're only picking high quality comfort equities that my financial advisor would already potentially have in his portfolio, in our portfolio. We're looking for short duration contracts. We're doing that for a variety of reasons because we like to rotate the capital. We'd like to control the scenario, and we can do that in a shorter period of time. And we are collecting premium, which is really the primary driver here. We want to collect an income premium for every covered call that we are selling an option on. The objective is to build a structured monthly income. The objective is to prioritize capital preservation, so we're not taking substantial risk here at all. We want to operate within defined risk parameters, and we're going to document that process transparently. I should also point out, it seems obvious to me, but I am not a financial advisor. This is not advice in any way, shape, or form. This is really just me sharing with everyone and with you what I'm doing, why I'm doing it, and the results. The operating framework, as I mentioned before, we're going to be doing a 3 to 10 day sell. Our delta target, which once again we'll talk about down the road, is 0.25 to 0.45, meaning what is the percentage probability that those options will be assigned. So we want to have a moderate out of the money cushion. It's actually something we're discussing whether we want to be always in the money or out of the money. I suspect we'll want to be a little bit of both. And so whether we're looking at out of the money or in the money, we're okay with assignment. So that if we are out of the money and we collect the premium, that's okay. And if we're in the money and we collect the capital gain and the premium, then that's okay too. So the idea of this, and that's why it's conservative, is that we're really okay with any result. And as I mentioned before, we have our portfolio of 22 US. Okay, so this is the trade of the week. We made four trades last week. The trade of the week was Coca-Cola. Our entry price was 78.52. Our strike price was $80. We had a 4 day expiry. The delta was zero point 0.3. So we had a zero point 0.3, a 30% chance, really, is what they're estimating with the delta of it being assigned. The premium collected was $52. I think the challenge with a lot of this is that people find it hard to get excited about $52. I get that. But what you really need to look at is what is the percentage yield, and how does that compare with in what I'm calling a conservative experiment here, portfolio. What is that percentage yield and how does that compare with the market? We have a 1.9% out of the money cushion. So we're not expecting it to assign. We're okay if it does. The break even now is $78. We're calculating break even, meaning we purchased it for 78.52. and we collected 52 cents. So our actual purchase price is brought down to $78. It's a very short duration. And as I've mentioned now a couple times, and I'll keep talking about, is we're okay with assignment. It fits our framework because we're respecting our delta range. We're okay with a downside cushion. We're holding equities that we're comfortable with, that we understand market fluctuation, that our outcome is acceptable either way, and if it is assigned, then it becomes a capital recycling opportunity. And finally, the performance overall week one. We started with $22,294.91 US. We ended up with 22,466 and 49 cents, which is a net change of $171.58. I get it. I get it. I get it. Nobody's going to be excited about $171. But really, what we need to look at, what I look at, is 0.77%, meaning that we're achieving just under 1% growth in 1 week. And so what we're really deciding here is this a vehicle that we can use to conservatively grow our portfolio? And do we want to expand it and scale it in time? Income generated, we generated $124 in premium. We had four positions. It was short duration exposure, which means we're recycling that money, we're collecting premium, and then making that wheel go again, that process go again. We have our delta range, and the idea is that we're setting very reasonable, conservative boundaries, and we're staying within that framework. That's it. It was a good first week. It was only week one. And I'm going to keep doing this, and show you what we're doing and how we're doing it, and really why we're doing it. That's it. Bye for now. See you after week two.